Thanks so much for tuning in to Talking Point. I'm your host, Neeraj Shah. Markets are, you can almost say that climbing the proverbial wall of worry yet again. And it's a rally that we've seen, which has been laden with skepticism from multiple quarters of the market. Somebody who's been constructive, though, has been Vikas Khemani. And I think it's an opportune time to get him now that the quote unquote supposed uh, obstruction to the debt deal is also done and away with, and Indian markets are seeing some solid traction on the back of good earnings and the return of FPIs as well. Because great having you. Thanks for joining in. I hope all is well. And contrary to what I had thought, your judgment turned out to be right. I'm just trying to understand how you're thinking about equity markets in the current landscape.
Yes, good morning. Good to chat with you. Like we discussed in the past, India story continues to remain one of the best story. And I think our key call was as the interest rate peaks out, and which we kind of made in on November, December last year, that over next 3 to 4 months, interest rates will peak out. And as interest rates peak out, which was of course linked to the inflation peaking out. So we said inflation will peak out, interest rates will peak out, and dollar will peak out. So those triple peaks will be made, and as those triple peaks are made, it will result into the fund flows towards emerging market. So that is precisely what has happened over last, and there was huge skepticism around inflation peak out or not, but we believe that components of inflation, energy prices, commodity prices, and food prices all were kind of looking southwards. And as that has happened, it is only a matter of time that interest rates has to come down. So we still believe that what we have seen is only beginning of a very long trend. Uh, Interest rates have started not coming down yet. It is only expectation that some point in time it will come down. So as that expectation gets only stronger and stronger, and as it actually starts happening down, you will see massive flow coming towards emerging market. And in India, particularly, we will get disproportionately large share of that because we are only in some sense a most promising growth story across emerging markets. So that faith continues to remain. So and there's no doubt if you look at our quarterly earnings and all, our growth continues to remain very well. Corporate India has done very well. There are multiple drivers of growth only getting stronger and accelerated. So if you look at all those things, there's no reason for you to be worried and bearish on market. You can only be bullish.
Valuations don't bother you because, and again, there's an argument that 18 times FY25 is okay. Just trying to understand how you think about them.
No, I think this is a very most common concern being raised about it. So when you put any number, and I don't think it is 18 times 25, but when you put any number, any valuation number, it has two things inbuilt into it: your assumptions of earning growth, right, and your assumptions about the interest rates, right. And both are very, very variable and changing depending on what is your earning growth versus my earning growth. And we can all say that consensus, we can take a consensus number, but we all know that consensus usually is wrong, like we saw in last 6 8 months. So taking a consensus number and making a build on the valuation is not right. Number one. Number two, if there is and I don't think India is trading crazily expensive compared to its historical valuation, compared to its promise vis-a-vis the growth. So putting a particular number and say it looks expensive, it probably would be wrong. Thirdly, I think you would also understand that valuation is function of two things. One is earning growth and secondly liquidity. And like I just made a build some few minutes ago, that we are going to be in a strong liquidity profile towards emerging market. If that were to happen, we are only going to get expensive. So you are talking about, whatever the number is, because, it will be 18, anywhere depending on the growth estimate, you can make it, whether it is 15 or 20, anybody's guess. But I personally believe that Indian market will get further re-rated from here. And, please note that I'm saying further re-rated. So when you are expecting a re-rating, the question of valuation where you are is not really worrying you. And I think that over next couple of years, India will further get re-rated in a significant way, and India will deliver well.
Interesting. So, okay, because let me ask you, let me not throw a number at you. Let me ask you, what is your valuation hypothesis? Because as you always say, that investing is all about making a hypothesis and investing and then figuring out how it turns out. So what is your numbers valuation hypothesis? Because I heard you say that you don't think we are at 18 times FY25.
So, like I said, that we all try to put some number, we all try to make some guesses, but I
Right.
personally believe that investing is all about getting the journey and direction right? And if you see over next 2 years, two things will significantly change according to me. Number one will be the interest rates. So if you look at that, interest rates come down by 1%, it has almost 12 to 13% change on the valuation. If I were to take 2% top in the interest rate, probably that will accelerate to about 25 30%. I don't know exact number, but if let's say EPS today PE is 20, if interest rates come down by 2%, everything else remaining same, even 25 PE is fine because it's a function of interest rates, right? So, 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 in my opinion, that direction is here to stay over next 2 years, and I can see that direction playing out. So that is one, and secondly, earnings will get accelerated. Now earnings can get accelerated depending on sector to sector, different level. But I think our job is to find companies with a high earnings growth and reasonable valuation, which can benefit disproportionately from the changes over next 2 to 3 years. So in that space, in my opinion, there are plenty of opportunity, and yeah, of course, you have to make your hypothesis about growth, right? And for that, you have to look at the levers of the sector. You have to look at the levers of many things. Like we've been speaking on manufacturing, right? No, not many people believed in manufacturing growth 2 years ago, 1 year ago. Now, as more and more people believe, further sector gets re-rated, right? So that's the kind of setup one would want. Today, also there are very lot of skeptics around India. As they get converted, India will get re-rated.
Got it. Okay. If I urge the current Vikas Khemani, who is a buy-side fund manager, to for a moment don his erstwhile sell-side hat and try and second guess whether this current, so it's constructive on the long term, 2 years, 3 years out, point taken. But this current uptick or the current rally, which is being filled with skepticism from various quarters, would the erstwhile Vikas Khemani believe that this current up move might well continue? There's FPI flows, earnings are looking okay, and India is the cynosure of all eyes. So, in the short term, could there be more upsides? Is it possible to predict that?
So there's no hat on that. I mean, buy side, sell side. It's very simple. I just articulated that. I think what we have seen in terms of flows is a beginning of a very long-term trend, right? And long-term, I'm saying it's a 3 to 5 year, even including short-term trend. So because right now we are beginning to see expectation of interest rates peaking out, getting reasonably well, so as these expectations are coming, flows are coming. Please understand it's a 30, 40, 50-year rule book. Whenever Fed raises interest rates or talks about raising interest rates, money gets pulled from the emerging market. Because most of the emerging market run current account deficit, their economies import inflation and thereby generate negative returns. So preempting, most people pull out money from emerging market. That was precisely happening over last 2 years or so. Now that is exactly changing, exactly turning. So if I were to go back in 2 years ago, when markets were extremely bullish and Fed started talking about, everybody thought, no, India is doing well. And, but we have seen that returns have come very poor. So whenever Fed is raising interest rates, tightening liquidity, emerging market returns would be suboptimal. There's no question of that, and negative most of the time. Fortunately for India, it was not the case because we have a strong domestic economy going and domestic liquidity supporting us. But as that changes towards interest rates coming down environment, you will see that flow coming back. Now you can put your imagination to work, saying that if that money comes back and couple that with the domestic money continuing and earnings continuing, whether India will do well in short term or not, my answer is even in short term, medium term, India will do well. Of course, time and again, small issues can keep coming. People will talk about one or two issues. I mean, any risk can come which nobody can predict. SVB was one risk, came unpredictable, right? So those kind of things can happen, but I don't see major risks to the India market even from a short-term perspective.
Got it. And Rose, it'll be interesting to see what happens if indeed things like what the Gavikal research was talking about, the India-Russia, if there is a rupee trade and if there is something like that with India, then the point about CAD also could be very, very interesting to see going ahead. Because you are very early in identifying manufacturing.
Sorry.
Yeah.
If I can reveal one more point, we spoke about this in the past. I said this, that why India is on a structural repair also, and which always leads to re-rating. India is repairing its current account deficit. Meaning in next 3 to 5 years, we will become current account neutral to current account surplus country. As that happens, its economy gets repaired because you don't depend on the foreign capital at all. And as your dependence on the foreign capital goes down, that when you don't need money, your rating goes up, right? People give you more money. Most of the AAA rated companies who don't need money get cheaper money. So India will get cheaper money. It means that it also stands for it makes a case for the re-rating. So that's a very very structural point I'm making.
Because what about themes? What do you like? What don't you like?
So, like we've spoken, again, I mean, more or less remains same. I think India is one of its best phase of manufacturing. So, we are seeing massive amount of opportunities. India GDP will double in next 3 to 5 years, rather I would say, on manufacturing side. And that happens, you will see many companies growing at 20% plus within some segments, of course. So manufacturing is undergoing a massive amount of change and across various segments, sub-segments is an opportunity. Banking again can't be wished away because banking continues to remain very well because financialization, as economy does well, it benefits a lot. I think consumer will come with a lag as the inflation prices are coming down and commodity prices, everything has been cooling off. I think next 3-4 quarters you will see most of the consumer company making base and getting stage ready for a growth in demand coming through. Last 3-4 quarters, I think we saw massive amount of destruction in the demand because inflation, of course, bit everybody, and especially more so in middle class. I see that changing over next 3-4 quarters, and thereby there will be a good opportunity to pick stocks which are good consumer stories, reasonably valued and suffering from the short-term down demand decline over last few quarters. So markets will have many themes keep coming, and you'll have to keep studying. And these are some of the themes we've been working. Interestingly, pharma is a theme also one could look at right now. We are seeing input prices are coming down, demand remains good. Even in pressure in US is beginning, the murmurs of beginning to kind of come down, pricing pressure. So, companies with large domestic portfolios, some international portfolio can be interesting case for re-rating. So some of these themes are, I think, playing out and can play out over the next few years.
Vikas, thank you for joining me today and giving us your thoughts. Really appreciate your time.
Pleasure, because always good to chat with you.